Hi, it's me Ajesh. Today, like last time, we had discussed about different loans. Not too much we went to, but the important two terms of loan, two types of loan, which are not much familiar to most of us. I won't say to anyone, but some of us. Yeah. So today we will discuss about some scenarios where we can use the different types of loan. So we will start with in case in a situation where you don't have enough, like you have started your mortgage and suddenly your income reduces, maybe due to a job change, or maybe if your partner stop working, anything can happen. In those situation, there is a type of loan that we can use, that's interest only. So in this case, what happens is you will only be paying the interest of the loan, so it will be a manageable amount. So usually people don't prefer to use that, but there are situations like this that you will have to use them. And in case of a revolving credit loan, if you are a well-planned, well-disciplined person and you know how to manage really well, in those cases a revolving credit loan is really good, because you will be able to reduce your loan repayment or loan interest. How much interest you are paying will be in a large amount. And the other one will be like the offset loan, which you have seen. Offset loan will be like the same scenario that I have shown, or I have told you in the previous video, that you have a savings account other than the KiwiSaver, and the KiwiSaver amount is enough to pay the 20%. And in that situation, you can use the savings account as a offset account, in that, so that you can your savings amount will be easy to reach for you. So you don't have to pay the bank, but your interest rate will be reduced. That amount, whatever is in the savings account, will be reduced from your interest rate, so you will be paying a lesser interest rate. Then there is table loan, I think. Yeah, table mortgage, I think it's the common type. You pay the interest rate, you pay the principal amount, a fixed amount, like it keeps on changing, different principal amount, you will be paying different interest rate, but your mortgage will be the same. The percentage of interest, usually it won't be like 50-50. You won't be paying 50% principal amount, 50% interest rate. It keeps on varying each repayment for every bank. Usually it's like that for every bank. In the table loan also, you will be paying the same way. Sometimes you will be paying the interest rate more, sometimes you will be paying the principal more. It depends on how much the amount is. So that's a common type of loan that we use. And then there is one more called a reducing loan. The concept of reducing loan is like you will be paying your principal amount in a fixed amount. Like for every repayment, your principal amount will be fixed. So the advantage of it is, like, in case you know that at the particular, like maybe after 2 year, 3 year, you will be changing the company, you won't be able to pay the same amount. In those cases, you will be keep on paying the principal amount more, the same fixed amount for every deposit, but your interest rate will keep on decreasing because you are quickly paying off your principal amount. That's a kind of reducing loan. So in those cases, you will be like planning for your future. After 2 or 3 years, you won't be able to pay higher amount. So in that cases, when you set the principal amount, higher amount first, when you have the capability to pay it, at the end you can just reduce that total amount that you will be paying by a lot. So that's a different scenarios that you will be using your different types of loans. And one more thing you will be like commonly used, like how these all are connected to your cash rate, OCR, the first topic we discussed. That's related to your fixed interest rate or a floating interest rate. Fixed interest rate means, like, if you are paying 5%, that's a fixed for 2 or 3 years, you will only be paying that 5% interest rate. And floating interest rate means it keeps on changing based on the market value. If the interest rate, market value for interest rate will be going down, at that time you will pay lesser interest rate. If it goes up, you will pay more interest rate. So it's a kind of it will keep on changing every time, floating interest rate. So the advantages and disadvantages, obviously from the name itself you will understand. You can predict the OCR to an extent. Some of the banks will be able to help you with that. Maybe someone who knows about these financial things will be able to like say, yeah, maybe the interest rate will be going up, going down. They will give you an advice. Listen to their advice, do your own research, and if the OCR is going, if the interest rates are predicted to going up, that OCR is going to go up, plan accordingly. Just make it to a fixed interest rate. If it's low at the moment, fixed interest rate for the next 1 year or 2 year. And if you are predicting it to go down, keep it at floating. When it goes down, fix it at whenever the interest rate is low. So these are the scenarios. So I'm again repeating, I'm not a financial advisor. So these are all just kind of deductions and things that I have did my own research. And see you on the next episode with something different. I am also getting bored with the banking things. See ya.